Hello, my name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,489 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this point, I'm going to hand it off to our distinguished moderator, Roger Royse. Roger, take it away.
Okay, well, thank you, Rob, and thank you, Idea to IPO, for hosting this event. I'll be your moderator. I'm Roger Royse. I'm a lawyer with the international law firm of Haynes and Boone, resident in Palo Alto in the heart of Silicon Valley. I have a couple of housekeeping items before we jump into our panel. What's about the future, 2021 in venture capital, and what 2020 was like. But before we get there, I want to let you know that this session is being live streamed on Facebook. It is also being recorded, so you'll get a copy of the recording afterwards if you want to watch it again or refer to it later. We do this frequently. Rob does this almost every day of the week. I do it pretty frequently as well. Next week, Tuesday, a week from today, we're doing a session on exit strategies you might want to log into. I just sent to everybody my LinkedIn contact. You know, when we used to do this live, people, you know, we'd be in a room, you'd exchange business cards, you talk to people, you get to tell people who you are. It's hard to do that virtually, but through the chat feature, not the Q&A feature, but the chat feature, you can actually share information with other people in the room. So feel free to do that. So before we get started, I would like to know who is in the audience. So I'm going ahead and send a poll. Are you a startup entrepreneur? Are you an investor like our panelists? Are you pure from industry? Are you a techie? Are you a service provider like me? Maybe you're a student or a teacher, someone from academia, government person. Who are you? Who is out there? And our polling is coming in with about half of the respondents, 70% are startup entrepreneurs. We have a handful of investors. We have quite a few tech people. Oh, more service providers than normal. And actually, we've got more students here, or academia, I should say, than normal. And with 80% counted, it is about 63% startup entrepreneurs. We've actually got a real good mix here. This is kind of a more diverse audience in terms of attendees than I'm used to seeing. So good, that'll inform the discussion. Okay, I'm going to end the polling. We had 82% and 63% of you are startup entrepreneurs. All right. Since we're polling, I have another poll that I'd like to know where you're from. You know, since we're doing these events live now on Zoom, we get people from all over the world. You know, mostly from Silicon Valley because of the nature of what we're talking about, but we definitely get people from other parts of the country and other parts of the world. Where are you from? Are you from Silicon Valley? Are you from other parts of North America? Are you from Europe, Western or Eastern Europe, Asia, Africa, India, South Pacific? Is anyone here from Fargo? I always put that on my poll.
What the heck is the Fargo question? Are you kidding?
From Fargo, so I just want to know if there's anybody else from Fargo.
Are you really from Fargo, Roger?
Well, I haven't lived there in a long time, so I don't know if I can say I'm from Fargo anymore. Okay, unfortunately, there are more people here from India than Fargo, so it turns out that venture capital is more popular in India than Fargo. And with 84% voted, we have about 28% Silicon Valley, about 40% other North America. That's interesting, outside the Valley. 6% Western Europe, 8% Eastern Europe, 6% Asia, I guess because of the time zone, we're not getting as big in Asia, and 2% India, and nobody from Fargo. Darn. I'm going to import other than me.
Really asking where my accent is from. It's from Fargo.
Well, there you go. Good. I probably know him.
Of course it is, yeah. It's cold up there in the winter time.
All right. So I sent to everybody through the chat feature. I'm going to talk about the chat feature in a minute, my LinkedIn link, and I also sent you an idea to IPO. If you're on Twitter, and I hope you are, I hope you're going to be tweeting the pearls of wisdoms that you're going to hear today.
Mhm.
Use the hashtag idea to IPO. So the Q&A and the chat feature. So when we used to do this live, the way it worked is Rob would come out and he'd give a little introduction and he'd say that people give him a speech. And the speech would be, okay, we're going to talk for an hour. We're going to go from noon till 1. There's going to be no Q&A. It's just going to be panel discussion. And at 1 o'clock, we're going to have Q&A. But from noon to 1, there's no Q&A. So hold your questions. We'll take your questions from 1 to 1:30 for Q&A. Okay, does everybody understand that? And someone in the audience would always raise their hand and say, is it okay if we do Q&A during the panel, or would you rather have us wait until after 1? And then Rob would say, what did I just say? So I'm telling you, we're going to do Q&A at 1, but you can go ahead and send me the Q&A in the Q&A box, and we'll save them up and we'll get to them. So if you have questions, put them in the Q&A box. If you have things you want to chat about, put that in the chat box. You know, that works really well. So with that, oftentimes people say we have a panel that doesn't need an introduction. I think we really do have a panel that doesn't need an introduction because they're so well known in this space in Silicon Valley. But I would like to let each of you say a few words and introduce yourself. We have Bill Reichert, of course, SC Modi, and Nuno Goncalves. Bill, maybe you could tell us a little bit about who you are and what you're doing and what you're really interested in these days.
Okay, wow, okay, sure. Yes, hi to everyone. My name is Bill Reichert, and I am a serial entrepreneur turned venture capitalist. Got together with Guy Kawasaki and we started Garage Technology Ventures many years ago. I'm co-founder and managing director of Garage, which is a seed and early stage fund here in the Valley. And then a few years ago, we affiliated with a big global fund called Pegasus Tech Ventures. So I'm now a partner at Pegasus Tech Ventures, which is a big global fund headquartered here in Silicon Valley, investing across the spectrum out of a $1.5 billion fund. And so we're investors in SpaceX and in Vicarious and in Bird and in Airbnb and a bunch of other interesting companies. And I am also, as part of that, I am the chief evangelist for the Startup World Cup, which is the biggest and richest startup competition on the planet, with competitions in 60 regions around the world. Make sure we get one in your region if we don't already have one. And over $1.5 million in prizes, including a $1 million grand prize. And wait, there's more. I am also the newly published author of my first Amazon book called Getting to Wow, Silicon Valley Pitch Secrets for Entrepreneurs. Rush to the closest Amazon store near you, which is online, and order your ebook today. Thank you very much. So that's me.
And you definitely should buy Bill's book.
Thanks,
Thank you,
Bill.
Nuno.
I
Thank you.
pre-ordered it.
Thank you, everyone. Thank you.
Nuno, how about you? Tell us a little bit about what
Sure.
you're
I'm going to try something different because I always do the same intro and I'm getting a little bit, I wouldn't say bored, but fed up of doing the same one. So I've been in tech almost 25 years. In 6 months, I will have hit 25 years in tech, which is a stupid long time. 3 very different stages to my career as an engineer and as a product manager at the beginning of my career. Shockingly enough, I still have a couple of enterprise software systems that have been in production now for 23 and 22 years, respectively. The middle of my career, I was an operator, growth operator, so mostly around strategy, corporate development, business development, product strategy, and product planning. And then I did the stupidest thing in my life, which I started my own venture capital firm, of which I'm still the managing partner, Strive Capital, 10 years ago. Through Strive, we've mostly invested and continue investing in the consumer and software as a service spaces. We're normally first institutional money in, so Series Seed, in some cases maybe Series A, depending on the size of the raise. We've invested in companies that you would know, like App Annie, Robinhood, DraftKings, and a few others that I've directly invested in. And as of last week, I've invested in officially 4 unicorns and 2 decacorns, so companies that are worth 10 billion or more. So very, very blessed to have been in this space for the last 10 years, although it's tough to be, an entrepreneur in venture capital. I can tell you that. Just to do my plug as well, I have a podcast show with Bertrand Schmidt, who is the co-founder and CEO of App Annie. He's now the chairman of App Annie, called Tech Deciphered, which is decipheredshow.com. So check it out. A lot of the things I'll say today, we've already discussed it at length. And our last episode was episode 18, which is the beginning of a trilogy on recruiting. So how do you recruit and how do you get recruited? Particularly important at this moment in time.
Hey, thank you. SC, welcome. Tell us a little bit about yourself.
Thank you everyone for having me. It's great to be here, and it's great to have these discussions periodically with Bill and Nuno and Roger. We're a good match. And so my firm, Mighty Capital, invests at Series A, a little bit Series B, mostly in the US, mostly in tech, but also a little bit of personalized medicine. And what we bring to our portfolio companies is exclusive access to over 300,000 product managers, plus the tools and best practices to reach them. And what that means is we engage product managers all over the world with a couple hundred events every year. So like ID to IPO for PMs, for product managers. We have a podcast that's a top 500 tech podcasts on iTunes. We have webinars, articles, all of that is authored by product leaders. Check size, we write anywhere from $500,000 to a couple million. We just closed our second fund, so we're eager to make new investments. My background, I spent 12 years, like Nuno, building products and companies. And so I worked for Facebook, Nokia, Siebel Systems in my prior to investing life.
Okay. Okay, thank you, panelists. Well, I know we're all anxious to get to 2021, but before we do that, I just want to ask a couple of questions. I was reading the NVCA Venture Monitor about this year, how this year is going. And interestingly, they say that the market has been remarkably strong, the venture capital market in the third quarter of this year, both in terms of dollars invested and numbers of investments. Although it's been down a little bit in seed and early stage. And I guess I'd start off with, has that been your experience as well? Have you seen a very strong market, Series A and beyond, especially later stage, and kind of a softening of the market in early stage? And do we expect that to continue? And whoever would like to start with that, go ahead.
Yeah, I mean, broadly speaking, it feels like COVID has not really made any significant difference in our appetites as venture investors. In part because venture is a long-term investment. And unlike the meltdown, this is very different than the meltdown situation where we thought we were going to lose the global financial, infrastructure, right? This has had a very, very different impact. And actually, in a very weird way, what it has done, it has pushed money into asset classes where people think there's long-term upside, and away from some of the traditional asset classes like, commercial real estate. Who's going to invest there these days, right? And so there's been plenty of money looking for high returns, and venture is one of the few places where you can imagine in the current world where over the long term you can get good returns. So I think that's what's going on here, and why it feels as though the energy, at least in the middle and in the growth stage, is strong. On the seed stage, it's, again, the Y Combinator batch that we went through a little more than a month ago, there was plenty of energy there. There was a huge amount of energy there. I don't know what the statistics are, but everybody has been looking at the Y Combinator deals, the Alchemist deals, the early stage deals. I don't know exactly what the numbers are, but I don't think there's a lack of enthusiasm by the venture community in those spaces. The angel community might be more cautious these days. That's a possibility, and that may explain some of the very early stage stuff.
I mean, just to add to what Bill said, and I agree with everything he did say. To add that there's a couple of routes that I think are important to explore here. One is the route to IPO. There's a bunch of companies that are IPOing this year. We're on the verge of a record-breaking number of IPOs, to be honest. And so in some ways, I believe the public markets have been maybe a little bit too optimistic, maybe taking into account there will be a vaccine and things will get sorted at some point next year. And therefore, I think there's already a lot of optimism put into the public markets, not just the classic institutional investors, but also into classic retail investors, because of actually the lack of better interest rates and bank accounts and other things. People are taking bigger risks and putting money into public stock. So there is a route to that, and that also leads the whole route from late stage investment, companies that are almost IPOing that need that last tranche of money before their IPO are actually raising. Robinhood did a raise this year, and a bunch of other well-known companies did as well. So there's a lot of that happening, and that I think justifies a lot of the late stage investing that is happening in the market. There's also the fact that you have VC firms that raised quite a lot of capital before COVID, and some of them were in the midst of COVID, continued raising very, very large funds. And Andreessen Horowitz announcing two super big funds, NEA with huge funds. Sequoia had already raised their growth fund, 8 billion, I believe was at least the first close. I'm not sure if they did another close. So there's a lot of activity happening in the mid to late stage. But in effect, the trend is what I would call the doubling down trend, right? I double down on companies that are doing extremely well, that I believe are going to IPO, that are going to be liquid very soon. And that's the doubling down that's happening. The appetite in early stage has diminished slightly because it's longer term, it's more complex. Some industries are still very unclear what's going to happen to travel, what's going to happen to restaurant business, et cetera. And so a lot of that, I think, is a little bit in motion. We are actively investing, but at the same time, I believe that sort of justifies that there's a little bit more of a conservativeness in early stage that we didn't see in the last few years.
SC, is that your experience as well?
Yeah, I mean, I don't have much to add to that. I agree generally with what's been said. One of the things we're seeing is a little bit of the B2B SaaS fatigue. It's like, is there, many people have subscriptions and many people have these B2B. So is there like a business model innovation, or is there like something around maybe, away from the software side back to a little bit more of the telco, 5G infrastructure, stuff like that. So we're seeing a bit of a shift in the focus that we've had like since say early 2020, but absolutely like huge drive to invest in venture capital, still very high valuations, and a lot of interest and interesting companies.
I want to kind of focus on something a couple of you talked about, is this IPO market and how that kind of optimism might be fueling what's going on generally in the market. And we've seen the rise of the SPAC this year again. What do you think about 2021? Is it going to be the same going forward? And does that fundamentally change, I guess how investments are made?
This is a portfolio decision, and in some ways the rise of tech stocks in particular, if we look at public markets, is because there aren't that many alternatives, right? Mm-hmm. So what are the businesses that are doing incredibly well under COVID? Highly digital businesses, right? Or digitally native businesses. Who are those businesses normally? Normally, classically, they're the really well-funded tech companies. And some of them IPO'd, some of them are already IPO'd. So that's why we're seeing, I think, this incredible optimism. It's almost like, it's not just that there's optimism around the company itself, but there aren't any other classes for me to play with volatility and upside. So I just put my capital there. That's why I believe there's a little bit of a bubble right now in the market, certainly in certain asset pieces of that market, of the public market. So I would be very cautious in 2021 and what happens. Mm-hmm. We're all at the mercy of COVID. I mean, I was talking to a government official in Europe, I won't say which country, and they were saying this is going to be tough. There's going to be a sell-off in certain markets once the numbers for the year are presented at the end of the year by most countries, right? So in January, February, when we start getting the real numbers of what happened, and it's not just GDP, it's what's happening in terms of industrial productivity, et cetera,
Yeah.
we're going to see a realignment of the market. And I don't know if I would be that negative, but I do believe we're going to have a little bit of a air cut into next year on the public markets. The SPAC part that you talked about, just one sentence on it. I'm not an expert in the mechanism, but it feels to me like someone is now using a great financial construct to take companies public without having to do some of the processes around underwriting or not a direct listing either. And for me, it feels like a vehicle. I think it will probably be overused over the next few years again. And at some point, we'll go back to something else, and the stock markets will adapt, and NASDAQ, New York Stock Exchange, will create the right products that address the issues that a lot of the investors have had over the years with listings, right? You know, they're cumbersome, they're extremely expensive, the regulations behind it are archaic. So in some ways, I think it's just a sign of times. We had the whole direct listing thing until middle of the year. That was going to be the next thing. Now it's SPACs. Maybe it's something else. I think it's a pressure point on some of these stock exchanges to just change the way they do things, and also regulators to behave in a slightly different way. So I don't see it as we'll have SPACs for the next 20 years. I see it as we have something that's going to create a different product for public listings.
Bill, are we in a bubble? What do you think? I'm sorry.
Yeah.
Go ahead.
I'm with Nuno on the SPAC being a bit of a the fad of the year. And I will say I have not lost hope that blockchain is going to completely disrupt that value chain of companies raising funding. I know right now it's less of a priority because we're going through the COVID crisis, but maybe at the other end of it, that will be one of the major drivers of change in kind of corporate and finance. Maybe we have a slightly different perspective on the IPO market. I think it's going to continue to be quite strong. And globally so, right? In the US, there's a ton of companies on the docket for exits. And internationally as well, there's a lot of like newly minted, European and Asian unicorns who don't have a ton of opportunities to get acquired by mega players who can pay $1 billion just to buy a company. And so they're going to have to go public. And then in the US, I think what we're going to see is more of the phenomenon of, public to private, like we just saw with Slack being acquired by Salesforce. And the reason for that is that one of the things that COVID has brought is a lot of uncertainty, right? Like executives and managers who were pretty good at predicting revenue and expenses are now like, are we going to hit our revenue, and therefore can we expense? And we see that especially when it comes to budgets, like budget allocations are being determined much later. Companies are really like tentative until they're ready to move forward very fast. So there's a lot more unpredictability in the way these large companies spend money, which means that when it comes to buying companies, they're going to wait until a unicorn or a large company goes public, like Slack, see how it does, and then decide like, okay, so yes, we're gonna put up the big check to buy them. So I think the IPO market's going to stay strong, and then public to private may also be strong in 2021.
So I'm going to totally disagree with my esteemed colleagues here. I think this is. Guys.
We have two different positions, Bill. You can't disagree with both of us, right? So what are you going to go for?
I'm sorry. You both said you expect the stock market to continue to be strong. Maybe we're whatever. I mean, this is a.
I didn't. I said.
Okay,
I think
you said it was a little bit of a bubble. Okay,
Yeah,
this is a train wreck waiting to happen, guys. I mean, this is, and okay, we were a little, you're a little bit more conservative than SC, but either way, I mean, neither of you sort of pointed out that there's no sustainability to the markets where it is right now. I mean, because look at what's happening in the world. We have gotten this massive misallocation of debt and equity around the planet, every single government entity on the planet, from federal down to municipal and village, is dramatically increasing their debt. Their budgets are totally blown. And then meanwhile, you've got the sort of core of our small business economy that has been gutted. Yes, great, because, you know, Google and Netflix, and they can continue going up, and Amazon because of Christmas, and yeah, la-di-da, but eventually the chickens are going to come home to roost. We've got, you know, massive unemployment around the world. This is not a sort of regional problem we're facing. We're going to have a global recession. Now, you know, we're going to see various things happening, but ultimately the chickens are going to come home to roost and the markets are going to go down. What's going to happen is the same thing that happened with SPACs the last time. I mean, SPACs are not a new idea. And what people found was, in an up market, SPACs are kind of cool and kind of sexy and kind of fun. But when the markets are flat or down, SPACs suck as a model, right? It doesn't play. So, you know, I don't know when it's going to happen. And you know, God bless. I hope, you know, you guys are right. And we'll sort of have a sort of gentle continuation of the way the market is going. But, you know, I am, you know, telling entrepreneurs 2021 won't necessarily be a lot better than 2020 was, because, you know, you had this overhang of cash that's looking for places to go. But in 2021, the overall macroeconomic play is going to start hitting. How does Google make money? Google doesn't make money other than by advertising. Who advertises on Google, right? So, you know, we're going to see a little bit more than a modest haircut in the marketplace over the next year.
And not because I need to agree with Bill, because we've disagreed many times, but I actually agree with everything you just said. And
Really? Okay.
if you go back to May, I remember saying exactly that
Yes.
what was holding us was very rational public markets, or, you know, maybe April, May, right?
Yeah.
You know, rational public markets was holding it. We had a big bubble replicating through from early stage to mid stage to late stage, you know, propagated in some ways because of SoftBank and many other players in the market. And I do agree with Bill that that bubble, for some reason now, is propagating to public markets, which had been the rational markets, and now I don't think they are. So I do
Okay.
agree with that. I don't
Okay.
think I agree with the extent of the bubble in that market. There are some intrinsic players there that are probably worth their money, and they just benefit tremendously from what happened with COVID.
Yeah.
Amazon being an incredible example of that. They just benefited incredibly out of that.
Yeah.
So that would be my view on it.
Yeah.
SC, do you want a rebuttal time here?
I do agree with Bill and Nuno on one thing, which is eventually there will be a reckoning when I think it's a little farther out. And the reason is, you know, when you think about, like, there's a ton of money out there, where can it go? It can go into debt. It's not going to, because interest rates are crazy low, which, by the way, justifies why everybody is borrowing right now, and the GDP, the debt to GDP ratio is skyrocketing, but maybe that's a good thing because interest rates are so low. It's not going to go into real estate because nobody knows what's going to happen to the future of real estate when people sort of go back to a quote unquote new normal life. It can go to public markets, but public markets, to Nuno's point, are a little bit irrational right now because they're really, like, I mean, diminishing returns. There could be a little extra returns, but diminishing. So where else but in private markets?
Taxes.
Well, on that, I mean, how is this sort of informing? I mean, this is fascinating macroeconomics, but how is that informing what you folks are doing and what you're investing in, and what our 63% of our attendees who are startups probably want to be doing to get your money?
You know, I mean, from my point of view, it is not relevant from what I do day to day in looking for brilliant entrepreneurs with novel technologies that are going to change the world. You know, and I'm a little bit anxious about our LPs. And, you know, I think that's the way it'll affect venture. I don't think it affects us at that front facing to the entrepreneur side, because we're investing for the long term in companies that are going to make a dent in the universe. But we as VCs have to worry about our LPs. and their anxiety about, how they're going to allocate funding, over the next few years. And so I think, to SC's point, the impact in venture will take longer than maybe the way the macroeconomic and government statistics suggest in terms of unemployment and all that sort of stuff.
Yeah, I agree with Bill. I think one of the biggest effects for us is our own investors.
Investment strategy
Whoops,
is
I see.
looking at the early stage companies, because the larger companies have less predictability in their revenue and their expense and more sort of uncertainty, they're going to be slower to at allocating budgets, especially for larger deals. And so what it means is that, if you're a startup company and you sell like small ticket items to SMBs, you're going to have like a few of your customers going out of business. So it's going to slow down your ramp. And if you're maybe a growing company who's trying to get into the enterprise with larger deals, it's also going to slow down your ability to execute because larger deals are going to take longer. And so it means like longer paths to, to growth. It means, you're going to maybe need to raise a little bit more funding. And more importantly, you're going to need to manage your burn a lot more carefully. So that, that's sort of how it's impacting the way we look at deals and entrepreneurs right now.
Yeah.
Sorry, Nuno, I cut you off. Go for it.
No, I think the macro situation is very important at several levels. One is what Bill was saying, which is really our own investors, which are limited partners. And they have a portfolio. If they're institutional investors, they have a portfolio of assets they're allocating to. And it was generally difficult. I was on the verge of doing, the first close on my next fund beginning of the year, and all of a sudden COVID hit, and no LPs would talk to me, right? People that I know, they wouldn't talk to me because they had to figure out, how am I going to rebalance my portfolio of assets, right? Even if I'm a family office, I need to figure that out. How am I going to put money to this and to that, and how do I generate liquidity over the next few months, et cetera, et cetera. So I think there was a genuine concern there that this is, that this is happening. The second piece is the customer logic, and it's true for B2B, but it's also true for consumer. Consumers are spending more time at home, but maybe they have less share of wallet depending on their situation, depending on the demographic you're hitting, etc. So obviously, you as a company need to figure out, how are the macroeconomic situation affecting the world, right? If people are more unemployed, etc. Some things are extremely resilient. I invested in one of the early precursors to the whole consumer subscription business model, and this company is doing incredibly well, and they haven't really, they keep doing well. Nothing has really changed through COVID. They're just doing well. So clearly some things have changed, some things haven't changed. I think what's changing now at the end of the year, and I'm much more optimistic than I was probably by mid of the year, is a lot of uncertainty points are coming out. Part of it is we're seeing waves 2s and wave 3s happening in some countries like China, in particular in South Korea, and a few other markets. We've seen in the US that things really never got settled, but that's it for a different discussion politically. But we do see that there is, vaccines are starting to come out. There's a little bit of a light at the end of the tunnel. I think we're still being maybe overly optimistic on timelines, but that brings players back to the market. The SMBs that have survived and now are making money, to SC's point, they're now have to think about the continuity of their business. Enterprises need to do something. That's why Salesforce had to acquire Slack, because they're like, okay, we have this opportunity here. We might not have it again. We need to buy into it, right? And so you start having more M&A, you start having more IPOs, you start having more liquidity injected into the market because of that. Because I think the uncertainty levels have decreased. Maybe decreased too much. Maybe it's too optimism, but they've decreased. LPs, for example, now are talking. They're interested. They're interested in putting money to venture capital firms because that clarity has sort of established itself, and in some ways got propelled because public markets were doing surprisingly well through the last few months. So again, I think the uncertainty piece has created something that is, I believe, a very positive effect for startups and also for us as venture capital firms.
That kind of plays into another statistic I ran across this week. It's that first-time financings are at an all-time low. In other words, it sounds like anecdotally, venture capitalists are putting more money into follow-on financings instead of in the first round. Is that true? Have you seen that happen? And is it affecting, again, is is what's been going on affecting the way you might otherwise approach your
I
investments?
don't think it affects us. We are normally the first institutional money in. It affects us in the sense that we are in a little bit of a cherry picking scenario. We have more choice because there is less first new investments or institutional new investments, right? Which is probably what you're referring to. We have more choice. We can see a lot more deals. I see a lot more top of funnel this year than I've seen last year. My associates, the principal at the team, etc., they see a lot more stuff than we used to see before. So there's more cherry picking. The reality is, in a year where there's been a tremendous amount of uncertainty, we've talked about it quite a lot. What bets would you make? If you have a portfolio that's emerging and gaining traction, you would probably double down on that portfolio. You would do follow-on investments. In some cases, we started seeing funds creating opportunity funds next to those funds to do actually just follow-ons, right? So in some ways, I think that's the dynamic of what we're seeing is you prefer to double down on something that's actually much less risky at this stage than to take the risks. But let's be very honest. There's a nuance around risk. A lot of people talk about risk as in, some industries are doing really badly. There are some industries that are doing exceptionally well, maybe too well, like gaming, remote work. I think the next bubble is going to happen around remote productivity because everyone on this call probably would agree that remote productivity needs to change. There need to be new tools. The tools we have are not sufficient. They're not good enough. So everyone's going to do a startup in that space and everyone's going to want to fund them. Yeah. So we're on the verge of another risk, which is we have things that are bubbling up too much because of the reality that we're in. And in some ways, that's a significant risk as well.
Go ahead, Bill.
So I just, let's take COVID out of the equation for a second, because I think there's another trend going on that's separate from COVID. It's hard to separate COVID, but I do think at the startup level, one of the things that we're seeing is an AI fatigue out there, I think. So separate from COVID, over the last 3 or 4 years, there had been this explosion of AI penetrating sort of every single market. You had AI in ag tech and AI in ed tech and AI in reg tech and AI in femtech. I mean, you had AI everywhere, right? And then underlying that, there were all these AI platforms. And then on top of it, there was autonomous vehicles and, smart cities and smart buildings and So we had this explosion of startups, sort of that were driven by this new AI, so this new next generation of AI. And frankly, I think one of the things that's happening now, separate from COVID, is a little bit of exhaustion in the venture community with yet another AI play. Because it's hard, I'm not seeing a lot of novel ideas in AI. I'm seeing AI applied everywhere, but I'm not seeing a lot of sort of exciting novelty in the AI space. AI has become, a commodity aspect of product development, I think. And so I think there are just too many startups that are doing kind of the same stuff. Now, I hate it when VCs say that. I hate it when so I know there's all these entrepreneurs out there saying, God damn you, Reichert, we have something novel. How dare you say? But I gotta say, it's just hard to sift through all of these startups that are doing something that, it's incrementally better, or they say it's going to be better. But, look at just a couple of examples, right? Look at LiDAR. So people said autonomous vehicles, they're the future, right? And so what do you need for autonomous vehicles? You need LiDAR, but LiDAR, old generation, too expensive. You had 75 new LiDAR companies that sprung up around the world, right, to solve the LiDAR problem. And then you had, bunches of people in radar and bunches of people in camera fusion and bunches of people, sort of starting up around this whole autonomous vehicle thing. And it turns out this autonomous vehicle thing is going to happen much, much more slowly than everybody was promising and saying. And you see companies like Drive AI kind of disappear. You see companies like Zoox that manage to escape, catastrophe by selling to Amazon. And so I think separate from COVID, we were at the peak of a wave of sort of generational technology that was playing itself out. So I think, yeah.
I sort of disagree with you, not
Oh,
fully.
good.
And I go back to what I did a couple of AI panels with Rob and Idea to IPO, and I always would introduce myself when I talked about my investments in AI, saying there's two things we look at, right? There's core AI shifts, people that are doing, genetic algorithms, that are doing stuff that is fundamentally different from what we had before in the AI space, right?
Okay.
For example, some of the sub areas around deep learning, et cetera.
Mm-hmm.
And then there's all the people that are going to ride on the existing platforms, the TensorFlows, the DeepMinds, et cetera of the world. They're just going to build stuff to it.
Right.
And that's an app economy. So to your point, I totally agree with that. There's a ton of companies riding on an AI because there are apps. We have the equivalent of an app economy because we now have all these deep learning and machine learning solutions out there that I can readily use and leverage. And so they just require a little bit of algorithmic understanding and finesse, but I'm just riding on an existing platform with, compute that is not mine, et cetera, right? So I think that's happening, and in some ways it's getting accelerated, if anything, with COVID, right? So it's still happening. It's just noisier. It's like the mobile app space, right? When it started, it was cool, and then it was very noisy, but still it was the mobile first and the mobile app economy, and it was going to exist, and it still exists.
Yeah.
So I'm much less bearish around it. The second thing, and this is not a platitude, but it is a true element of strategy and market and sort of watching markets evolve. And I was a strategist for a part of my life. It is always the case that we underestimate how long it takes to get to a real revolution and innovation. We always underestimate. So we always, in some ways, overestimate the speed at which we get to the revolution. But then we always underestimate the revolution itself and the impact.
Well,
So I think we are totally underestimating what's going to happen with self-driving cars and what's happening with that. I agree with you. There was a lot of optimism. I'm a venture partner at Christian Robotics. We looked at a ton of companies in that space and we did not invest. And we looked at the entire stack and we did not invest. And we clearly saw there's years to go for this to work, right? But when it happens, man, the world will be different. It will definitely
that's
be
actually
different.
playing out in autonomous vehicles off-road now. Good.
Okay, SC.
AI on top of the mobile data sets is waning down, except in the very deeper layer of the economy, like supply chain and that kind of like really like deep enablement, where there are still some opportunities. Where I also see opportunities in AI are on, applied to other data sets, like genomics, like, blockchain data sets that are not the mobile data set, which we've been collecting for the past 10 years. I do also think that we are at a kind of in-between platforms, but they are right now candidates for brand new types of platforms. And I think the ones that are sort of obvious and ready to become platforms, Zoom is a great one, Airbnb is a great one, Uber is a great one, where they've basically enabled a whole new set of data collection that is ready for the picking, ready for building applications on top of it. Zoom is definitely a platform that could be revolutionizing the way we work, and isn't right now. Right now, there's still a tool as opposed to a platform, because there isn't a lot of app developers on top of Zoom. Same thing for Airbnb, same thing for Uber. But these, as they grow, as they become public, could become platforms in and of themselves and open up a bunch of new opportunities.
See, you might move a little closer to the mic when you speak, so we can hear all of that. But on that point, let's follow up. Let's talk about some other industries that have been big winners in 2020, and we expect to continue to be big winners in 2021. Digital health seems to have really gotten to be a big sector. Are any of you investing in digital health or health tech generally?
Yeah. Well, my latest
Yeah.
unicorn as of last week is in the digital health space. So very happy with the market momentum we've seen, the relaxation of regulations, which in some ways were totally archaic in the US. Obviously, there's a lot of stuff
Mhm.
broken. And if you look at healthcare very realistically, not just human healthcare, but for animals and pets as well, we've had a relaxation also of regulations. All of that I think has been extremely positive. I think this is the beginning, though. This is the beginning of the wave. We still have much to see in digital health, access to consumer, fundamental shifts around payer and providers and their relationships. I think the best is still to come, but this was sort of the electric shock I think the industry needed. The whole relaxation of regulation, et cetera, was incredibly important to what's happening right now.
Yeah. And I would, and I would strongly agree. And I think there are some things that are emerging that, again, we were promised a long time ago, but I think we may be, sort of on the cusp of seeing more and more of this, partly and thanks to COVID, and that has to do with new methods of drug discovery and drug development. Built around the combination of CRISPR on the one hand, which had all this enormous, amazing, incredible promise several years ago, and now we're starting to see some of the fruits of that technology. We're seeing sort of the second generation of CRISPR that is now becoming practical in a lot of drug development, drug discovery kinds of things. And then on the other side of that is actually, as SC is saying, the application of computing, of AI, and related technologies to drug development, drug discovery, discovering methods of action, new chemical entities, new targets, new biomarkers. So we are seeing this explosion happening in health, biopharma, medicine, digital health, devices, in data, that absolutely have been jump-started, triggered, ignited, shocked by COVID, as Nuno was saying.
So kind of continuing with that, so
Yeah.
pharma, bio as well, not only digital health, any other sectors? SC, what are you involved in? FinTech, EdTech, anything else that you feel really good about?
Yeah, so we're really excited about personalized medicine. More recently, to the point of like there's a whole body of data and a whole set of platforms that are waiting to be leveraged. Genomics data, CRISPR platform, really platforms that cure cancer in a very personalized way, devices that treat in a very personalized way with the advances in robotics, 3D printing, and all that kind of stuff. So that's an area where we're definitely looking and excited. We're not as excited about digital health, the app that's going to monitor your health. We honestly don't believe people really want their health to be monitored, at least at a mass market level. And so changing behaviors to make everybody healthy is still kind of a bit in the dreamland at mass market, right? Other areas we're excited about, I mentioned, platforms that are going to be built on top of the new emerging kind of market leaders like Zoom and Airbnb and Uber. And for us, the big difference is really seeing how, these players, the way they have emerged is by competing against sort of massive distribution and free, right? When you think about the Slack, the Zoom, the Atlassian, the Datadog, Amplitude, DigitalOcean, all of these players are competing in markets where you have, Microsoft and Google and Amazon really as dominant players who are offering services that are free and massively available. And how do they make it through, right? And how they make it through is with product excellence, which I think is a massive change compared to previous generations of innovation, and really driven by by the mobile revolution. Like what you can do on smart glasses or smart watches or a smartphone, you expect consumer grade experience, which means that now you expect it all across the board. And so that creates an opportunity for these platforms to really be about like the best product wins, which, used to not be the case. I built products for Siebel and Oracle, and I know we don't need to have a great product to win. But I think now you do, and that's a massive difference.
That's all right. That's good. So,
Let's just,
so Roger, before we hit Q, I mean, I'd love to sort of throw a whole bunch of other things into the pot if you're ready for that, or if you want
Okay.
to wait.
okay, no, go.
Yeah,
for
no,
it.
I mean, some other things we haven't talked about yet that I think are sort of interesting evolutions that we're going to see in 2021. We're going to see space tech become a real thing. People have been talking about space tech, and full disclosure, we're investors in SpaceX, but their Starlink service, they've got almost 1,000 satellites up now. It's an unbelievable what they've been able to pull off. And so I think we'll see, sort of dramatic expansion in access to the internet through Starlink and other services in space tech, and then creating new platforms in space. We're seeing Microsoft is talking about putting data centers in space. Really interesting, stuff in the space tech space. On the computing space, there are 3 companies out there that are going to launch photonic chips this year. It'll be interesting to see how that battle comes out. But the idea of being able to use photons instead of electrons at the chip level to do compute is super interesting. People have been talking about it for decades, and it looks like there are a couple of people who are going to be able to pull this off. And so I think we're going to see the emergence of photonic computing in 2021. I think we're going to see this emergence or explosion of privacy tech as a whole category that's going to explode. You as a lawyer, undoubtedly, you're seeing this all over the place, because every jurisdiction on the planet now is using privacy either explicitly for their citizens' constituents to protect them, or defensively to protect their country from, US hegemony, right? So you're going to see some interesting geopolitics around privacy tech, and which ties into this.
Hello,
Oh,
Bill,
we
we lost you.
your audio.
Yeah, I think
Can
we
you hear me
lost-
now?
Now
Oh,
you're
yeah,
back.
now we can
Yeah.
hear you.
You can hear me now.
Yeah.
Okay. So I think we're going to hear more and more of high-tech nationalism. I'm not sure how that's going to affect us as venture investors, and then alternate foods, right? I think we're seeing an explosion in alternate foods, whether it's plant-based meats or cultivated, lab-grown meats, or, alternate sources of protein. I think, that's a whole thing that we're going to see more and more of in 2021.
Yeah,
Just to throw some stuff on
I would probably just say, for the thing probably that gets me the most excited right now about the next few years is consumer. Everything about consumer, or almost everything, is going to change. And everyone's like, oh, no, we're going to go back to something. I'm like, this has been habit forming, right? I mean, people have been in their houses under some type of shelter in place, lockdown, variations thereof, since March, almost across the entire globe, right? It's not just the US. This is going to change how we perceive our home. We saw, early on in the pandemic, that everything that was selling was stuff for the home, for, doing food and cooking and whatever. It's changing how people are consuming gaming, right? And gaming has gone through the roof in many subcategories. It's changing media. In a fell swoop, the whole logic around slots for movie theaters, whatever, forget about it. It's done. It was almost there, right? It was just COVID was the last nail in the coffin, and now HBO Max is saying, well, we're going to also publish it at the same time we publish it on theaters, and then we're going to take it out, and then we're going to bring it back. So they're still trying to do something hybrid in the middle, but that show, that train has left the station. Literally, there's no way back right? Slotting is not going to come back in the same way we saw it before of content. So everything's going to change, and that creates a ton of opportunities, right? What do I do in my home? How does my home become my center of activities for fitness, well-being, for content and media consumption, for gaming? How do I interact outside of my home? How do I interact with other people? How do I bring in my own services and my own setup in my home in a world that for sure is going to be work from home a lot more than it was before? We can all disagree whether it's going to be fully distributed or fully liquid or not. I'm more of a believer that we're going to have a hybrid world in between with hubs still. But for sure, we're all going to work more from home, right? And so this whole thing about bringing your own service is a done deal. It's going to happen. I mean, it's already happening, right? So I'm fascinated by that. That's what excites me right now. All of that on top of the fact that we're having a generational shift to Gen Z. Plus, we have the first sort of generation of seniors that are tech savvy in some way. I mean, it's like, I think that's perfect storm time. The whole taxonomy is up for discussion, right? So for me, that's the most exciting thing that's happening right now.
So, in terms of, again, what you're investing in and where you're investing, one of the things I think we saw in 2020 is that it's hard to have in-person meetings. So I think we've seen VCs investing outside the area. Although, again, the data has shown most of the companies, there's more of a focus here in Silicon Valley has done well. The rest of the country hasn't done as well in terms of the venture community. How about you? Are you more willing now to invest outside of this neighborhood? And have you been doing that? And will you be doing that in 2021?
Yeah, absolutely. Well, I mean, it is, at least from the Pegasus point of view, Pegasus has always been global in their investing. We did, but we did our first, well, one of it, we've done now several investments without actually meeting face-to-face, human-to-human, the entrepreneurs. We did one of our first, non-meeting investments in India. And it was interesting, the psychology that, sort of all of the meetings, all of the discussions were no different than if they had been in San Francisco. It's just that, no, they were in India. And so the whole Zoom flatness, no question, the flatness of Zoom helped them seem no different than any other entrepreneur. Then when we got down to the legal docs, all of a sudden reality hit us. That was, that almost killed it. But in terms of everything up until the legal docs, it's interesting, the psychology of Zoom.
You mean the terms, the actual terms? Because
no, not so much the terms as in jurisdictional issues and issues of, option plans and, securities law and, that level of legal detail.
Got it. And that's why you're always going to want to invest in Delaware corporations, regardless of where they do business, for sure.
Yeah. I mean, so Roger, God dang, somebody should solve this problem and create a sort of universal global jurisdiction, for startup companies that I don't know. I mean, it's a much larger issue, but boy, it would make so much sense if
we've got one. It's Delaware.
Yeah, thank you. Right.
Well, it's a very American centric, but yes, correct. Correct.
Thank you.
How about USC?
Okay.
Changing the way you're investing in companies?
With US versus rest of the world. What has changed though with COVID, we invest where our network of product managers is strongest. And it used to be that to be a great product manager, you needed to be at, mostly headquarters, right? Because it's a job where it's like a people focused, relationship focused role. And what has happened with COVID is product managers have had to work remotely. And therefore now they're sort of everywhere, much more distributed. And so we're actually able to invest across the US, of course, with a concentration in the major tech hubs, so East Coast, West Coast. But across the US we see that we're able to deliver value even when the companies are not on the coast.
Okay. Well, we are at 1 o'clock, so I think it's time to open it up to Q&A. For those of you who have questions, you should type them in the Q&A box, not the chat box. and we'll try to get through a few of them. So we have one here. What stage or MVP should we begin to seek funding? I have a business plan. I'm not working currently, but don't want to heavily invest in a web-based infrastructure for my B2B cloud service. So that may be a little earlier than what you folks tend to invest in, but you might have some advice for this
I
person.
mean, I always give the example, if you can't raise any money from friends and family early on and you're that early with an idea, it's going to be difficult to raise from anyone else, right? Because that's what people are going to be looking at. People that know you the best, are they giving you money, even if it's little money? Um, the added issue is the cost of developing services, be it software as a service, basic enterprise software, and consumer software, has decreased dramatically, right? So it's an order of magnitude every 3 to 5 years almost. So, it's almost like, can you bootstrap it? Yes or no? If you can't bootstrap it with your own money, your own capital, etc., then can you raise a little bit of money, a couple of 100K or not? If you can't, then you definitely can't raise it from micro VC firms or VC firms, because I think that's like the bar is just totally different. It's a bar if, do you have a company? Do you have a team? Do you have anything that we can take a look at? We certainly don't invest before an MVP. Even at an MVP level, it would be a tough call, but before MVP, it's almost impossible. It would be a rare exception for us.
Let me ask you about that, because
In
I've
software, I'm talking about software, obviously.
generally, I've heard the conventional wisdom, if you got a PowerPoint, you go to your friends and family. If you've got a product or a beta or proof of concept, you go to the angels. And if you got revenue or traction, then you go to the VCs.
I think generally speaking, that's true. Sort of that would be the different proof points. The way I think about it is a little bit more nuanced. It's you raise from wherever you can, and if you're raising your first round and it's still at the idea stage, and if you can't raise it from people close to you, either you're the best salesperson since sliced bread, which some of you are, or it will be very difficult to get capital from people.
Bill, can
Just
someone
because
get
you're
to
nice,
WOW
etc.
without having raised any money? They couldn't see you?
I've met some people that are exceptional at salesmanship that can get money from angels, well-known angels, very early on, with no traction, no MVP. But again, it's the salesmanship of that. It's just, I am not that guy. I couldn't do that type of salesmanship. So I take my hat off. I wait for the traction. I take my hat off, and then I'll consider investing. But certainly the appetite for that risk. I think you summarized this really well. Normally, that's how I would look at it. VC's traction, angels product or MVP, and idea stage, you go a few people around you or you bootstrap. Honestly, there's variations on this. You can take higher risks earlier on if you're a VC firm, if there's something that de-risks the deal to you, and come in a bit earlier, MVP, some very early traction, etc.
Yeah, and that's fair. I mean, yeah, and the answer is yes. Entrepreneurs can get me to wow. At all different phase stages. That doesn't mean I'm going to write the check then, right? And so, Nuna's point, you've got to be appropriate for one of our funds. And that can be all over the place. Sometimes we'll invest pre-revenue. In other cases, we need to have a production product to believe in the opportunity of the company. So it is so situation dependent. In terms of this particular question and this particular sort of MBA grad, I'm a little anxious about I can't invest in web infrastructure, and that makes me a little bit concerned because boy, you should be able to spin something up. You should be able to spin something up, over the weekend to demonstrate some level of capability. I go back to, so I encourage entrepreneurs, go back and read the way Bill Gross would spin things out of Idea Lab, back in the day. And he was the master of, he'd put up a web page and there was like nothing behind it, but just to see if somebody would show up. And then he would get, college students to run around and solve whatever it is, right? And then sort of reply back on the web page just to see if there was a there, just to, sort of prove that, this is before we talked about product market fit, right? But, and what we're going to want to see is we're going to want to see a scrappy entrepreneur who is, capable of making extraordinary progress despite a lack of capital, because of the resources that he or she is able to tap. And, we love to see scrappiness as an indicator of the momentum that an entrepreneur can get. If we see that, then we'll stay. We'll be clear. And, you're too early for us now. I'll look for some angel friends. I'll look for some other people who might want to invest in you to to get you this first level. I'll even help you with that, even if I can't out of our funds invest in you. So yeah, it's never too early to talk to investors. You got to talk to the right investors, and you got to hit their hot button. You got to get them to wow. Just to do another plug, you got to get them to I see that you've got something extraordinary that even if you don't have a ton of traction yet, you're still the kind of entrepreneur, team, idea, target that an investor wants to invest in.
I'll add a slightly different perspective to this,
Mhm.
which is
Mhm.
what happens, right, between the friends and family that Nuno is describing and the wow that Bill is describing, and maybe a trap for entrepreneurs to avoid. One of the ways that I see a lot of folks in Silicon Valley get around that kind of like that small desert is they go to an accelerator. They get a little bit of funding and a little bit of dilution. And then it's not quite enough to get to wow. So they go to another accelerator to get a little bit of extra funding and a little bit of extra dilution, and maybe even sometimes a third one. And by then, they're pretty much unfundable. And the reason for that is dilution, which basically says, if you give up like 10% to your friends and family, say 5-10% to the first accelerator, 5-10% to the second, then your pre-seed accelerator, you give them like 10-15%, then your seed accelerator, same thing. Basically, there's no room left for your Series A and Series B investors. And so they have the hard choice of saying, well, either I'm going to cram down your early stage investor, which means they will never get a deal from them anymore, or I'm going to cram down the entrepreneurs, which is bad for you, and also will almost guarantee that there won't be any motivation to make the business successful. And so just something for folks to think about, like really be scrappy during that phase rather than try to get like some money for a little bit of dilution, because that could really hurt you down the line.
Okay. So we have another question. Somebody asks if COVID-19 has thinned the herd for startups. In other words, has it made let's phrase that a little more positively. Has it made the community stronger? Are there better companies out there? Nuno, you said you were seeing lots and lots of deals. Are they better companies?
I'd say in general, yes. If it's a company that's existed in the market, that's gone through the pains of having difficulty raising money, had to do a bridge with existing investors, or magically raised money, or whatever scenario in between that you can find. So in general, I think the companies that are in the market, they've become better, and many have gone out of business because they couldn't stand it and they couldn't really, raise money. The negative effect we've seen is more top of funnel, which is new startups, because there have been a lot of layoffs, because there's been this cool thing, all startups are great, etc. We now see even more tourists, I think, starting their own companies. People that probably shouldn't be starting a company, that don't understand the first thing about the pains of being an entrepreneur and scaling a company. And I think we see a lot more of that. And that's what created the noise that I was alluding to earlier that you just talked about, Roger, which is we have a lot of tourism, right? So for me, it's like, have you been in the market? Have you raised some money or not? How are you doing through COVID? For me, it's a really important set of questions just to start a conversation. If you're starting something from scratch, the bar is much higher because the noise levels are much higher. It's not that you don't have the right to be in the market. Of course you do. And we know a lot of great companies that were formed around crisis. A lot of people can tell you those examples, but there's too much noise going on right now. There's a lot of fad entrepreneurs going onto the market right now that shouldn't be entrepreneurs because they're going to go through the pain, and I'm not sure they're going to withstand the first sign of pain or blockage.
I mean, with all due respect, I mean, I generally agree with your point. I hate the reference to entrepreneurs as tourists. I mean,
But there are,
yeah, but I mean,
honestly,
it's always been
honestly,
true.
Bill, we
It's
have to say the
always
truth.
been.
There are tourists, entrepreneurs that are doing this because it seems cool, and they don't understand the first thing about being entrepreneurs. And it's fine, but it's like it creates a ton of noise for the rest of the market, right?
Yes
And
and
it's
no. I
fine.
mean, I mean, it's very few, in my experience. I mean, I don't think they're doing it because it seems cool. I think they're doing it because they think they've got a clever idea and or they are desperate, right? But I don't think there are a lot of tourist entrepreneurs in the sense of,
I fully disagree with you. Fully
okay,
disagree.
I
Yeah.
think there have always been, entrepreneurs out there who did it because it was cool. I don't think this era is any different, but I do think it's too broad a brush to paint new entrepreneurs with. And so,
No, I'm
but
not
there
saying it's everyone
underlying
that
a,
is new. I'm not saying
okay,
it's every.
all
I
right,
was very
all
precise. I said
right.
it's not everyone that's new.
What? Yes,
It's
I
just
know.
some
I'm
people that
just
are in the
saying.
market right now shouldn't be in the
I'm
market. That's the thing I
yes.
said. Yeah.
I know that's what you said, but how do we take that, right? And so it's always been the case that there have been plenty of entrepreneurs that are never going to get funding, and the issue for entrepreneurs is when you are starting out, make sure you tap a network of people who have experience, who can give you good advice. Don't try to do it on your own. Don't bang your head against this, funding brick wall unless you reach out and you find people with experience who've done this before. There are plenty of angels out there you should be able to tap into who can tell you whether or not what you're doing makes sense. So I agree with the fundamental point, which is that there are a bunch of people who are trying to do this who are not going to succeed. And for whatever reason, whether they're tourists or whether they just don't have the experience, the issue is there's now enough resource out there because the world is flat, because of how much education has been going on in entrepreneurship, for any entrepreneur, for whatever their motivation is, to go make sure they get good advice and then listen to it and process it. Not, and so I do think, yes, there's been an explosion of entrepreneurship, related to COVID. There's been a death of a whole bunch of companies related to COVID. So it's not that we have culled the herd and made the herd stronger. We've just sort of shifted the gene pool somewhat in terms of what's going on out there. So yes, I get your point, and I don't mean to overstate, what you're saying, but in terms of what's helpful to entrepreneurs, just make sure you tap from the beginning. Go find good people who will advise you in terms of what it really does take to build a company.
And I think everyone is on their learning journey, and finding advisors I think is a great advice. I think it's also on us as investors to develop effective screening mechanisms so that we give to folks what they need at the right time, right? So I see, for example, a lot of investors will just like ignore these early stage entrepreneurs rather than try to educate them or point them in a good direction. I think it's also up to us to do that work of making the ecosystem better as a whole.
Good advice.
And that's what idea to IPO is all about, right, Rob?
That's
right, Roger. Right, Roger.
That's right. That's right. Good advice. Get good advisors. Educate yourself. Come to programs like this. Learn how the system works. Meet good people. So, what do you think about investing in emerging markets these days? Is this an opportunity? What's been going on? Will that be a bigger sector next year, or is it harder?
Well, it's no question.
I didn't answer earlier. We've been geo-agnostic since we started in 2010. And so before it was cool to be geo-agnostic or multi-geo, we were geo-agnostic and multi-geo. First investment was a Japanese company that IPO'd within 2.5 years of our investment. So I'm very bullish on investing outside of the U.S. Emerging markets, as Bill was alluding to earlier, there's some risks around the legal frameworks, et cetera, that turn things into very complex deals sometimes. And actually, normally the deal becomes more complex than just the discussion of the term sheet almost. So we are selective. We're very selective. We still look at emerging markets, be it Latin America, be it in Africa, be it in parts of South Asia and Southeast Asia. But at the end of the day, we're super selective. For me, China, just for as an example, is not an emerging market. Just to be clear, China is one of the most developed markets in the world. We've made investments in China. In China, I normally like to co-invest. So I normally like to go with a few investors that I know that can do the due diligence on the ground piece and de-risk a lot of the legal piece around the due diligence. Otherwise, I think you can get fooled quite quickly in China. I lived in China for 6 years, just as background. So it's not someone who's lived in the U.S. making a comment. I lived there for 6 years in Beijing.
Yeah. And on the Pegasus side, we have an office in Southeast Asia. We've made over 40 investments in Southeast Asia. This evening I've got a board meeting, in Vietnam. So we are investing in emerging markets, and it is tougher. It is tougher. And for all the reasons I think we've already talked about. I think one of the secrets, though, and just looking at our patterns, is that pretty much every company we've invested in an emerging market has had one of the founders who has spent time, I think almost all in the United States. One may have just been the UK, but in other words, the founders have global experience, and one, and then two. One of the other factors is sort of just fluency in English and in the terminology of capitalism, right? And so it really helps if you're in an emerging market. It helps you if you have as part of your team people who have had global experience, who have had, have some bona fides in particular in sort of the US venture capital world at some level, the high tech US venture capital world. So I think that's an element in terms of what enables us to get comfortable more quickly.
For us, there's a couple of reasons we don't look at emerging markets at this point. One is there's still a ton of great deals in the States, enough for us to deploy the capital at the pace we want. Two is what Bill was talking about earlier, which is the terms, the co-investment ecosystem, syndicates, even employee incentives, very, very different depending on where you invest. And then three, which is probably one of the biggest reasons, is the potential for exits. There are less acquirers outside of the US, or less US companies willing to acquire non-US companies, which means it's much harder for us as venture capitalists to make our customers, right, our investors happy by providing them liquidity.
Okay, we got some specific comments. Would like to know your comments on agriculture technology, agri-tech or ag tech. One of the hottest, fastest growing, most solid sectors there is. Are any of you investing in that space?
I've looked at the space quite heavily, both the hardware part of the stack, where there is physicality to it, people that are trying to automate a lot of the processes in ag tech, but also looking at services and software as a service in particular as a proxy to digitize a lot of the industry, which has sort of struggled. Less so on what I'd call hardcore food tech. And then we look quite heavily at the end of that game, which is food tech in general, food delivery, et cetera, et cetera. So it's a space that's going through a lot of complexity right now. I think over core, if we would call it the upstream market of actual agricultural processes, etc., is ripe for disruption. But it's a very complex market, highly fragmented from the land perspective. You have a couple of really big players in that space selling stuff, be it seeds on the one hand, be it equipment on the other. Very difficult to take them out of the market. Those value chains are very deeply entrenched. So it's always been very difficult for us to pull the trigger on something significant, but we keep looking at that market. I think on the downstream piece, the revolution around food, as I said, I mean, what's going to happen to restaurants? How will they need to change the way they figure out their takeout strategy, their food delivery strategy? If we went back to the beginning of the year before COVID, everyone was talking about food delivery. Almost nobody talked about takeout. I still remember the one entrepreneur that came through the room and said, "We're going to do a restaurant in Colorado. These guys are actually very successful right now. We're going to do something in Colorado, and it's going to be very focused on not just people can get the food delivered as a dark kitchen, but also there will be takeout. And this is how big takeout is in the U.S. And we think it's huge. And this is well before COVID. So again, I think there's a lot of opportunities there. The food delivery unit economics are still very much crappy for the most, to say the very least. We're going to see now the DoorDash IPO. A lot of it will come to light, but definitely for us, that part of the value chain is much more exciting, and we're focusing a little bit more attention on that. The upstream piece is still ripe for disruption, but we haven't figured out what it's going to look like. We haven't seen anyone really disrupting it significantly.
Bill, I know you wanted to say something.
Yeah. I mean, it's such a broad span, and as Noonan just pointed out, I mean, there's just so many different elements to it. When we started talking about ag tech, we were very narrowly, well, I don't know if this is fair or not, but we were pretty much focused on the farm, right? And there was a lot of focus on, sort of how to improve yields, or reduce costs for farming, broadly defined, through a whole bunch of different technologies. And we've looked at all of those technologies. That became an IoT world. It moved, from land to sea, and turned into, shrimp farming IoT and fish farming IoT. And then beyond that, so we looked at novel material science for fertilizers, and for novel material science and biotech for pest control, and then gene modification for plant adaptation, and then there's the whole, where Noonan was going to farm to table issue, that whole chain, and improving that, and so we have made a couple of investments in, for example, in a company that is using biotech to generate collagen. So collagen is used, now that's on the animal side. Generally, we get collagen from animals. It's used in a whole bunch of things. Is that ag tech? I don't know. Plus, we're investors in DoorDash and in Gobble and in, sort of that end of the spectrum, which is now more food tech than ag tech. But I think, so it's exploding. There's all sorts of things happening in ag tech. It is a painful sector to invest in because pilots are so painful. It almost at the food level, it's like life science investing, where you've got to go through some cycles, to get there from here. And then you have this added overlay that all these neat new technologies we've got are problematic in ag tech, like genetic modification. So there's amazing things we can do with genetic modification, but there's a whole sort of political social overlay that is constraining us on that front and scares venture investors, and for investing in that space.
From our perspective, we're less interested in the consumer type opportunities for the reason Nuno mentioned, which is the economics are just really tough, the unit economics. And when it comes to the B2B opportunities, we think about them more as life science opportunities. So we like to invest with a strategic investor,
Mhm.
which means, we haven't yet found a deal in that space, but we're actively looking and interested.
Oh, good to know. How about supply chains, kind of sort of related, SC, since we're with you? Is that something you invest in as well? There's a good comment here about 2020 showed us how fragile the supply chain is
Yeah.
and how interconnected it is. And if there's one little blip, it messes everything up. And of course, there's opportunities there. Are any of you focused on that?
Yeah, I mean, my board meeting tonight is a supply chain company in Vietnam. I mean, and it's, a couple of guys who came from the US and the UK who realized, oh my God, there's a whole bunch of low-hanging fruit in countries like Vietnam in terms of just simply digitizing the whole supply chain process. And now that, every street merchant in Vietnam has a smartphone, why not digitize it all, right? And so, yeah, I mean, that's, I think Nuno made the comment earlier, or SC, in terms of how much of the infrastructure of the world is still surprisingly sort of old-fashioned, legacy, whatever,
When
still.
you think about, what goes on a ship, it's still not possible in most cases to know what's on it unless you load it yourself, right?
Yeah.
We have lots of things to
Or you
So
go through all the paperwork,
we
right?
we heavily focus on that space, but not from a supply chain perspective, but rather from a different perspective, which is to minimize the supply chain in that perspective. So we look very heavily at marketplaces around what I'd call food to home, to distinguish from farm to home rather than farm to table, right? Because it's not just to restaurants, but to homes, and we look very heavily at marketplaces in that space. I invested in 1.1, which is an indoor farming aeroponics infrastructure, fully roboticized, which is more around bringing some of this food closer to the cities, right? Suburban areas, rural areas, but closer to the cities, where we keep having the issue exactly that SC was mentioning, which is, the stuff gets put in a ship to come here for reasons we don't really understand. I mean, surely there would be better ways for us to get produce. So I think there's going to be a lot of innovation around that. Not so much around investing in the supply chain itself, which I think is broken, but potentially trying to fundamentally change it and collapse it in some ways.
So we're
But-
coming.
Well,
Sorry.
I mean, just a last sentence on your point, Roger, which I think is a key point that we didn't really touch on, which is this resilience question. And I do think there's a whole bunch of stuff that's going to emerge around this resilience point in terms of, where Nuno was going in collapsing the supply chain or rationalizing the supply chain or building redundancy into the supply chain, which nobody, the last 50 years has all been about eliminating redundancy in the supply chain. And I think, more and more companies are going to have to figure out, I need to have some redundancy, some second source, some alternatives, given the fragility of the world that we didn't fully appreciate until this year.
Yep. So last question.
Environment. I think we see a lot of our portfolio companies create these redundancies, not just in two different factories in China, but China and Mexico, or just because of the geopolitical tensions that are just increasing.
So we didn't get through nearly, all the questions that we had. So I'm going to post my LinkedIn information, but if people want to reach you, how do they get a hold of you? SC, how does someone get a hold of you?
You can just see my email right here, sc@mighty.capital. Feel free to reach out to me. I'd be happy to help.
Good, Bill?
Yeah, and you can reach me at bill@pegasusventures.com or reichert@garage.com.
Nuno.
For me, LinkedIn, but do write in the note when you're connecting that you were at this event. Otherwise, I don't know, where did we meet somehow, or e-meet?
Right. Yes.
Okay.
Agreed.
Okay. Well, thank you very much, panelists. I'm going to hand it back to Rob.
That was an awesome panel discussion. SC, Bill, Nuno, thanks for being with us here today and sharing your expertise and your insights. Roger, thanks for moderating. Audience members, thanks for tuning in and asking great questions. Happy holidays. Best wishes for 2021. See you next time.
Thank you.
Thanks,
Bye.
Rob. Thanks.